Welcome back, investors. Jake here. It's been 2 days, but we need to talk about the stock market drop that occurred on Friday because it was an absolute bloodbath. Unless your portfolio is just made up of Lockheed Martin and Northrop Grumman, more than likely your account was negative on Thursday and Friday. This is the heat map you can find on finviz.com to see exactly how red it was out there. The S&P dropped 2.7%, NASDAQ down 2.5%, Dow Jones down 2.8%. And the obvious explanation why this is because Federal Reserve Chairman Jerome Powell says taming inflation is absolutely essential. And a 50 basis point hike is possible when the Fed meets in May and makes their announcements. Everybody knew that a 0.25% basis point hike was more than likely. But the fact that the Fed is signaling that they're going to go more aggressive with a 50 basis point or a maybe even 75 basis point. What does this mean? When we go on the Federal Reserve's website, you can look up the federal funds effective rates. This is the interest rate that commercial banks have to pay to borrow money from the Fed. This gets passed on to consumers whenever they get a car loan or mortgage, or maybe even a business loan. And here you have the current federal funds rate is basically 0.2%. So if this were to increase by 50 basis points, it would go to 0.7. That would put us exactly where we were back in March of 2017. So when is a potential recession coming? When is a contraction in the money supply going to occur? And I still think we're a ways off. I still think it's going to be a while before this interest rate gets high enough where it starts deterring people from borrowing money. And it's coming. It's coming maybe potentially by December or January, end of the year. The Federal Reserve is now talking about potentially getting, the interest rate up to 3% by the end of the year. So what is happening on a macroeconomic scale? When you have inflation, it means there's too much demand for a limited supply of both labor and materials and services. So by contracting the money supply, by increasing rates, they're attempting to kill demand. So this will bring down the cost of labor, this will bring down the costs of materials and services. But in order for that to happen, some businesses have to fail. Some people might even lose their job. And that is what causes a recession. So this is planned, this is inevitable. A recession is coming. No one can predict exactly when it'll happen. But the market is going to have these knee-jerk reactions anytime the Fed says, we're going to get more aggressive about raising the federal funds interest rate. All right, let's pivot now and talk about my brokerage accounts, which is not looking good. But the S&P year to date is down 10.94%. The NASDAQ is down 18.99%. And my Schwab account is down 31%. I'm going to explain to you exactly how and why this happened in this video. Year to date, I'm down 19,000. I basically started the beginning of the year at 60,000. And if you're relatively new to my channel and you don't understand the history of my Schwab accounts, this is my active trading account. So in my 401k, my IRA, and my Fidelity account, all I'm doing is buying and holding S&P 500 index funds. That's over 75% of my wealth. In my Schwab account, this is my active trading account, basically my let's have some fun and see what we can do account. And on January 1st of last year, I started with 25,000, and I've not added any money to this account in the last basically 16 months. So I had a really good year in 2021, and I just actively traded starting at 25,000, and I got it up to 60,000 by the end of the year, by January 1st. So I'm moving in the wrong direction, but over the last year and a half, I still haven't lost any money. But it's obvious my thinking about this market, what I've been doing for certain trades, it's not working. And I need to think long and hard and come up with some new ideas how to trade options in this market when there can be such dramatic drops on pretty good companies with solid fundamentals. When we look at my accounts, it's just becoming basically a graveyard of red positions. We can quickly go through some of these. HCI Group, I'm still holding this. They're going to have an earnings report coming up soon, but I'm down 50% on these 100 shares I'm holding. I still think potentially by the end of the year, if TipTap's revenue growth accelerates, that this can be a net positive for me by the end of the year, so I'm going to continue holding it. AVAV, I just made this video last week, and that's how difficult it is, guys, to pick individual stocks and active trade. So I purchased AVAV on the 18th, right here, and as soon as I touched it, it crashed 20%. So you can see my position, I'm down 19.71. And AeroVironment is the Kamikaze drone company. I was saying to myself, for sure there's going to be a press release in the next 2 months saying that a huge order is going to be put in for these drones. And then the Pentagon announces a rival company's drone, the Phoenix Ghost, is also being sent to Ukraine basically for testing. So it's potential that there's a potential that this Phoenix Ghost is a better loitering munition kamikaze drone. This could get a huge government contract, and AeroVironment won't get it. So within a week, I got trapped in this position. So now I'm gonna hold it through earnings through the next month. I don't see why the government can't give a contract to both of them for a huge order, saying make as many as these as you can. We want them now. So I'm going to hold it, but definitely the momentum in this trade got killed. Let's go through a couple of these. My debit spread on Google and Amazon are both negative. Adobe's gone negative. These Facebook calls from 3 months ago are an absolute train wreck. On Friday, as the market was being sold off, I said to myself, it's oversold. Let's buy just 2 calls 1 month out on SPY. And they immediately went down 15% as soon as I bought them. Texas Instruments down 32%. So the only position that I have that is positive right now is Apple. These contracts are still up 38%. And I'm not the only one who's made this observation. Here's an article from Barron's. Apple is the last FAANG standing. And when you look at the performance of FAANG, and this acronym doesn't even work anymore, it's no longer good. I don't think anyone's considering Netflix a hyper-growth company anymore. And Facebook's also been annihilated, and it's called Meta now. But look at these year-to-date returns for these mega-cap tech companies. Netflix is down 63% in 4 months. Meta or Facebook is down 45%, once again, in just 4 months. We'll toss in NVIDIA, down 35%. Microsoft, down 18%. Google, down 17%. Amazon, down 15%. And the best performing one, Apple, is only down 11%. And this is where this week gets dangerous, guys, because Microsoft and Google are giving their earnings report on Tuesday. Facebook or Meta is giving it on Wednesday, and Apple and Amazon is giving it on Thursday. And I don't think the reports for these companies will be bad, but I think what will be bad is their Q2 guidance. I think this war in Ukraine and the COVID shutdowns in China are greatly disrupting the manufacturing and sales for these companies. Case in point, I can give you a data point here for me personally, but on March 18th, I ordered a new MacBook Pro. I got a couple upgrades to make it, this is going to be my work laptop for the next several years. So I ordered this over a month ago, and they said it would take 4 to 5 weeks to make it and ship it to you. So I said, okay, I gotta wait a month for this. And then as we approached the date that they were promising delivery, I got an email saying, just kidding, it's gonna be another 4 to 5 weeks. So now they're telling me I can't get this laptop until late May, which would be over 2 months with Apple to get a laptop. That's good. That demand is there for, people that are loyal to Apple. I'm not going to go out and buy a PC laptop just because I can't get my MacBook Pro now. But there has to be some people willing to do that. That if Apple doesn't have these iPads and MacBook Pros in stock, then they're losing customers for people that need it now. They need the equipment, today or this week. So this is very concerning for their supply chain issues and their manufacturing. Apple is still a fantastic product, but they just can't make stuff as fast as they can sell it, which is going to hurt Apple's growth. The surprise story of last week, surprise to me, maybe not to other people, is Tesla's revenue grew by 81% from last year. So for the period ending March 31st, Tesla reported a revenue of 18.76. Previous quarter was 17. So when you go back 4 quarters, that is a 81% growth in revenue. So when you look at the stock price of Tesla, it didn't go up at all. How does a company that grew its revenue year over year by 81%, expanded their margins, lowered their operating costs, how did the stock not go up? And once again, it comes down to valuations. This is why I personally have never gotten involved with Tesla, but their price to sales is 18, and this is a market cap of over now $1 trillion. So Tesla is already priced in this tremendous revenue growth. So if Tesla hadn't met expectations, it's kind of scary to think what would have happened to this stock. And since it's so large now, it does greatly affect all of the indexes like the NASDAQ QQQ and State Street's SPY. So I'm thanking Tesla in this video for doing their job, meeting investor expectations, absolutely crushing the quarter, and basically saving the S&P for that day. However, it still caused a sell-off. Where's Tesla's share price going to go in the short term? And I don't know, guys. I don't trade or get involved in Tesla. Well, let's go ahead and look at some of my other positions on the charts. And Amazon is not too concerning. It's basically just falling back down to this level of support it's reached a couple other times at 2,800. I firmly believe that a bounce is coming for Amazon. I'm not concerned about Amazon. Google, on the other hand, broke this key technical level of support at 2,500, and this is kind of terrifying for my debit spread. Expiration date is September, so I'm not too concerned. I think this will recover by then. But the investing thesis here is that advertising revenue is going to slow down, and that's going to impact Google the most. We're going to see Google's report on Tuesday, their guidance for the second quarter. Hopefully Google can get a bounce. Adobe, I am starting to regret this position, guys. Broke through this level of support at 420. Maybe it can recover, but if I can just get back to break even on these call contracts, I think I'm going to get out of Adobe. After seeing Netflix get completely annihilated, I'm basically flirting with disaster with Adobe with these technicals. I need to find a better uptrending stock, not one that's basically locked in a downtrend. So I'm giving you guys the warning now that as soon as I get back to break even, there's going to be a bounce of some kind next week. I think I'm going to exit my contracts on Adobe. Apple is doing its thing. It's between this range of 150 and 180, where it's been going back to November of last year. I think Apple will be fine, even if they give weak guidance going forward. Facebook is the interesting one. I don't think it's going to be good. After seeing Netflix losing subscribers, I think Facebook already announced last quarter that they saturated the global market, that they're not going to be adding daily active users going forward. So unless they magically found a way to monetize their users to a greater extent than they already do, Facebook could, if they absolutely crush it and they have some brand new product coming that's going to blow everyone away, then yeah, it could get back to this 220. Or more than likely, it's going to fall to where it was at a previous low in the COVID crash. This stock, if it has a really bad quarter and bad guidance, probably will fall to 140. The last position we should probably talk about is Texas Instruments, because I've been holding this the longest, and it was looking good. It was looking good, trending back up until Jerome Powell spoke, but I think if I can get back to break even on these contracts as well, I'm just going to get out. Texas Instruments reports also on the 26th, so I'll hold it through earnings. Hopefully, I think it'll be good, but all the semiconductors are just kind of selling off right now. So I've mentioned this in previous videos, but one of the headwinds against the market right now is the rising yield rates on government bonds. And this is pretty dramatic. So here we were, about a month and a half ago, the 10-year Treasury yield was offering 1.72%. If the Fed stops buying bonds, the yield rate has to go up to attract investors. There's an auction held every week for all of these government bonds, and the yield is now up to 2.9. And there's a game going on with all these fund managers right now. Let's pretend that you're a fund manager and you're assuming that the S&P by the end of the year is going to be negative. So you can either be 100% in equities and match the return of the S&P if it's negative 10% or negative 15% or whatever. Or you can mix in bonds, which will guarantee you a positive 2.9. Even if you were 70% S&P 500 index funds and 30% government bonds, by the end of the year, you would outperform the benchmark. You would outperform the index just because you mixed in a little bit of bonds. Now, active fund managers should be doing more than just buying index funds, but a lot of them do backdoor indexing methods where they just try and match the market returns plus get their fee from their customers. But it's going to be more and more tempting to just sprinkle in some of this positive 2.9, positive 3, positive 3.5 if this keeps going up. And this is money going into government bonds that's not going into equities. It's not going into the S&P 500 index fund returns. So this is a huge headwind for the markets, and this is going to cause a lot of pressure on the market to go down. Where else is money going or not going? I think it's interesting that Bitcoin is below 40,000, where it was basically a year and a half ago. I don't buy crypto because I personally think this is also going to deflate as the money supply contracts and interest rates go up. I don't think this is good for more speculative assets such as cryptocurrency either. So let's go back to the chart and check out the stochastics, because I had about $12,000 in my accounts. I was watching the technical indicators as the market sold off. As soon as the %K line got above the %D line, I deployed the rest of my money. I was trying to time this based on the technicals. The %K got back above the %D. The market was going up until Jerome Powell opened his mouth and said a 50% or 50-point basis rate hike was coming. So I still think a bounce is coming next week as the shorters will cover. People will spend the weekends looking for deals. Large funds will probably take new positions. But I'm going to be honest with you guys. I think as soon as we get one of these up cycles, remember this just happened last month. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 out of 11 days were these large green candles. I think another one of these rallies is coming. I'm going to be watching the technical indicators. As soon as the percent K gets into the overbought range and then it crosses below the percent D, I'm going to deleverage my account and then once again come up with some new ideas to try and make money in a stock market where the Fed is going to be aggressively raising interest rates. That's the lesson that I need to learn from Thursday and Friday. And hopefully my account can recover. Hopefully your account can recover. That's all for this update, guys. If you want to let me know how your portfolios and your accounts are doing, I'd love to hear it. Let me know in a comment down below. Till the next video, take care. Watch out.